Welcome to Power Charting, and this is the first day of summer. So I think we should celebrate the first day of summer by watching this video. And then after that, let's go to the beach. And I hope that there's beach time for you coming up this summer and that you can spend some time at the beach looking at charts, which is what we do wherever we go, right? So today we're going to talk about inflation. And the question is, what inflation? There's no inflation. The Fed tells us inflation's too low. Well, let me give you a number. So let's say currently the Fed is targeting a 2% inflation rate, roughly. So I don't know how you do that. Inflation's kind of has its own mind. But if inflation for the next 10 years is 2% per year, an item that we could buy today at $100 based on this inflation rate would 10 years from now be $121.90. So $121.90 to buy an item that we could buy today for $100. So that's just at a 2% inflation rate, which sounds like a pretty high inflation rate to me, because here's the deal. We have to grow our assets above the rate of inflation after taxes year in and year out. And if inflation is just persistent year after year after year, it's like a silent tax on our capital. And so this is something that we really need to focus on while we're at the beach. And so today we're going to have a discussion about inflation, but we're going to start with a discussion about financial stocks, because today or this last week, I promised you I'd look at a few financial industries groups and stocks. So I want to start with that. I'm going to go really fast because we have way too much to do in the time that we have. And then after that, we're going to talk about some measures of inflation. Okay, but first, very exciting announcement. TSAASF.org, which is a not-for-profit technical society, which I joined when I was a very young technician, and I'm so glad that I was a member. I continue to be, is having a free webinar, which is on the Dow theory. Dow theory is very important to Wyckofians because Richard D. Wyckoff developed his methodology and his approach in the era of the Dow theory, which is the granddaddy of technical analysis methodology. And so when I taught the graduate course on technical analysis at Golden Gate University, I started every semester with a discussion of Dow theory, both for its history and its importance as a technical approach and a trend following method. So this is going to be a great session. Alex Ivanov, who was mentored under Richard Russell, who was the modern day Dow theorist, and recently he passed. We miss him, but we have Alex now, and he is going to discuss the Dow theory. Just go to the website, it's right at the top, register, and join us for this July 1st presentation. It's going to be a lot of fun. Okay, let's get started. We have a discussion of bank stocks to start. And here, this is the U.S. Bank Index. I want to show you the upward stride since 2016 of the banks, which had an acceleration, climactic surge, distribution, and then broke down. You can see, look at this beautiful distribution area, and then you can see the support. Here's ICE. After falling below the ICE, it broke down out of the trend channel, and now it's riding on it. Well, do low and falling interest rates help or hurt the banks? Well, I think that a flat yield curve with very low interest rates is generally a huge challenge for bank stocks. And so this is going to be interesting, but notice this, that here we are right on this demand line of the trend channel, and this demand line is being flirted with, and you can see that let's go here and look at the relative strength. You can see the relative strength continues to be very weak for the bank index. So with that in mind, let's move on and look at a bank stock. Here's JP Morgan, which is certainly one of the finest bank stocks out there this modern day. You can see here that we appear to be in potentially a reaccumulation structure. So you can see climactic surge above the rising trend channel, automatic reaction, secondary test, up thrust, and then a spring or shakeout down to the demand line of the trend channel. And then since that time, JP Morgan has been one of the better acting banks, and you can see it's riding along its rising demand line. And again, with the bank index is flirting with that demand line. And we would, what I find encouraging about this chart is you can see here the relative strength is better than the bank index and is riding right along the long-term moving average. So if it can move up here, it could become leadership and then jump out of this reaccumulation area. And also as this pulls back here, notice that the volume is diminishing. So the volume is drying up, which shows a lack of supply, and it's pulling back into what I believe is a last point of support. And if we can convert this into a good rally up and out, this would be very constructive. But again, we have a situation where I think these low interest rates with a flat yield curve make it harder for banks to be able to generate growing profits and grow their asset base. But this is a very well-run bank, and the banks are in much better shape than they were, say, 10 years ago during in the aftermath of the Great Recession. So I think that the banks are an important area for us to consider, but we need to see, as with JP Morgan, good relative strength and a good uptrend. So moving on, we can see that this is full line insurance, and this is a large distribution with an upthrust at the end. So let's draw here, across here. You can see the upthrust action, which failed dramatically, which is what upthrusts do. And then notice that here is the area of the ice. And after this very sharp break, look at there's really no lift in prices at all. And see these tails over the market, which shows supply is present. And you can see that volume is generally quite high through this whole period, with an absolute breakdown here of prices, which produced a very dramatic bear run in full line insurance. So let's move on, and you can see, well, relative strength, make a note. But look what's happened with this very good rally that we've had. Excellent rally, jumped up, and now full line insurance is leadership. Okay, here we go. Let's do a point figure count. So here, let's count this distribution across here, which I've already done the calculation. And this is 21 points across of distribution from 57, which takes us down to 36. So you can see that it missed it by one box, went to 35. So there's a classic distribution. So when we were looking at that industry group and we're saying, well, look at this breakdown, how far can this go? Well, it broke down dramatically, and it did go down, down, down from 57 down to 36, which is a lot for what is typically considered to be a conservative group, which is full line insurance. I believe that this very sharp rally that we're having here is really the result of the fact that interest rates have fallen so much that they have massively increased the value of these insurance companies' bond portfolios. And so the insurance companies are getting relief because their bond prices in their internal portfolios that they run their businesses on have done quite well, and this is really helping. So here's full line insurance, the index. This is the one box reversal. We just looked at the three box, and the one box reversal takes us up 15 points. And so we can see that this gives us a target of 55 to 50. So we've just hit the lower end of that target zone. There is more to go, and so we would continue to think that this trend could continue, especially being that there's good relative strength in the group. Here's a stock. This is Hartford Financial. Look at this beautiful rally. Here's our distribution. Again, looks just like the group. Breakdown off of an upthrust and then sideways trading. After it broke down, it became very dull and quiet as it just weighed. Distribution was taking place. You can see the tails here, and then an outright breakdown, which then turned into a nice reversal. Again, Hartford was rallying with the bond market. Okay, so let's move on. And I wanted to just show you this because this is what interest rates have done. 7 to 10-year treasuries, thinking about the Hartford and the full line insurance, you can see here that interest rates have fallen dramatically. They're down to 2.03% as of today so far, and they had achieved a rate of around 3.25% before the breakdown. So a tremendous drop in rates, and this acceleration has overcome the highest count that we can count in this accumulation area, which I believe means that this is going to, in short order, pause, maybe come back into the target range, but that interest rates have had their move, and now they're going to be in a trading range for some period of time to come. Okay. Now, American Express, you can see here, nice trend line, and American Express has truly been one of the important leaders in the market. Look at how beautiful this is. Well, we know that the credit card companies charge very high interest rates, but their cost of capital has dropped dramatically here, which we just saw in the last chart. And so this helps them to raise their margins and their profitability. So here we can see a breakdown of the trend channel, but then a beautiful rally from the end of the year as interest rates were falling dramatically. And notice that the relative strength continues to just be on an upward tear. Even when there was a breakdown in prices, it didn't break down the relative strength. This is just a terrific looking chart. Now we just want to see American Express stay above its demand line here currently where it's at. And okay, so now let's turn our attention in the time that we have left to inflation. So a classic measure of the raw materials of inflation is the Commodity Research Bureau Index, which is composed of commodities that go into the real economy. So here's the breakdown. 39% is energy, 41% is agriculture, 13% is industrial metals, and 7% is precious metals. And you can see that generally since the beginning of 2016, the raw materials that are making up the CRB have generally been moving sideways. Now, arguably, this is a large accumulation that goes back more than 3 years. And this large accumulation could resolve itself with a turn up out of this resistance zone into a new markup. But this, and people, you know, quibble about what should be in an index like this that measures the cost of raw materials, because we know that if raw materials go up, eventually it's going to go into the prices of finished goods. And part of what the Federal Reserve is looking at is they're seeing this sideways trend in raw materials prices and saying, what inflation? There's no inflation. And so let's unbundle and look at some of the components here and see if we can get an idea about potential emerging themes. By the way, gold today, June 20th, is up, looking at the futures are up around $38. So that's a substantial jump in gold prices. And go back a couple of weeks and look at my gold video that we did, and you'll be able to see some interesting trends in gold and precious metals prices. Okay, so here we go. So here's crude oil. So interesting thing, again, I'm going to go quickly. I have a lot to cover. Here's potentially accumulation in gold, in crude oil, which is 41% of the makeup of the CRB, or maybe it's 39, I forget. Anyway, so notice the uptrend. After a shakeout in early 2016, even though the uptrend has been quite poor and relative strength here to the S&P is pretty lackluster, there is a trend of rising prices in crude oil. And currently, there's a bout of weakness that's taking place, and I'm sure that the Federal Reserve has been focused on this and seeing crude oil prices really languishing. So is it possible that this is a last point of support, a test of that, and then a turn up? Well, we're going to watch crude oil very closely and see what happens with crude oil. I was going to show you, let's do a 10-year chart, and you can see, well, this doesn't even show you, but back in the mid 2000s, crude oil got up to $145, and so here it just shows it up to 110. But you can see the base here is quite large, and crude oil has been much higher than it is right now. So if this is a base and it turns up and starts to mark up in a meaningful way, this could be very telling about what could happen with inflation in the future. So again, we'll watch that closely. Here is a point and figure chart of lumber. Now we're going to go into soft commodities here. The one thing I want to say about commodities is don't trade commodities. Don't go into the futures market and start trading any kind of futures, commodities, whatever, unless you are thoroughly familiar with the whole mechanism and how they trade and how the different months, because these commodity contracts expire. And so you really need to have real knowledge of how they work. I don't even encourage people to trade them. I want to look at these because they're a measure of inflation pressures and trends, and look at the raw material components. But again, I don't encourage you to trade them unless you're extremely knowledgeable about trading futures and knowledgeable on the risks. So here we are looking at lumber, and here is the, let's try this. So let's do a point figure count of this area here, so we can see a rally up into a last point of supply before the breakdown occurs. We're going to count from here to the high, and this is 9 columns times 3, which is 27 times 4, 108. So, and the scale is 4. So 108. So this gives us a count down to 336, 304. This is our count, the high end and the low end, and look how well it targeted the area of the accumulation base that we've just had in lumber. Now, lumber is considered a soft commodity, and soft commodities are typically grown, where hard commodities are things that are mined, or in the case of oil, pumped out of the ground. So hard commodities, soft commodities. So we're primarily going to look at soft commodities today. So you can see here, beautiful point figure count. Well, now we have a base. Look at this base. So we should be taking account of that. 13 columns times 3 times 4, 156. This gives us a target of 464 to 444. So 464 is above the top of the chart, but look at this incredible move in lumber, which has a lot to do with the lowering of interest rates, which is going to stimulate demand for lumber, which is used in the production of homes. And so a huge, and this is a world, these lower interest rates are a worldwide phenomenon. So there's going to be tremendous demand for lumber as we move forward. And so we continue to have higher counts in lumber, but look at that sheer rise, which we call a catapult wall in lumber prices, quite dramatic. Got to keep going here. Here's that base in lumber. Now we just counted this area right here, but there's a much bigger base in lumber. So there is the potential here for a very large point and figure count, which we will save for another day. And all we've done here is rally lumber up to the top of the range. But if we take this whole count, lumber could very well go back up to the areas of the high and maybe higher that were made in 2018. Okay, soybeans, large distribution. You can see here climactic surge. Climactic, oh, I was going to do this. So we have a climactic surge across here. We have support here. Distribution, breakdown. We've built a base in soybeans, and look at this dramatic rally that we've had. Now this is a daily chart. Dramatic rally in soybeans. All of a sudden they've woken up and they've become quite active. Well, let's see if we can put this in context. So here's the point and figure chart. Have to be careful when you count distribution. We're going to count from here. We're going to count from this area to here as our initial count, and that is produces, because of the scale of 5 points, 105 points, which gives us a count of 825, 805. And let's see, where's my, okay, there it is. So 825, 805. And look at how well that count worked. Beautiful. So now we have the potential for accumulation, and we're going to look at I think we're going to move on and look at some other soft commodities, but we can see here that soybeans are acting really, really well. So here's wheat, big base, beautiful run up in wheat. It's up to prior resistance. And so all of a sudden these soft commodities have come to life. Now I want to show you a chart back. This chart actually goes back 10 years, but notice this, that we have resistance. We are approaching resistance that we have made going back to 2015. And this becomes a potentially large accumulation count. And so here's a continuous contract. Now what they do is they do a calculation where they're able to put together all the expiring contracts near months and do a continuous calculation so that we have beautiful continuous charts to do our analysis on. But here's the base here with wheat across here, and you can see a pretty sharp rally that has gone up to the area of this rally and this rally. So this is important resistance. What we would look for with wheat is whether or not it can persist. It's maybe to a new high, but then when it reacts, instead of reacting sharply down like the prior two times, it just pauses and goes sideways. And then is in a position to start to mark up in earnest, and then we have a large point and figure count to work with. And here is corn. Here's a daily chart of corn. Look at how it has just come to life. Now, this really sharp rally in corn has been produced after a nice accumulation area, a nice base. And so we want to know if corn can continue to run up. And so here we can see that corn, in this case, going back to 2015, that there's a large accumulation area. And this is why you always want to go to the larger chart size. If you're studying daily, go look at the weekly. If you're weekly, go to the monthly. But make sure that you understand the context of the larger picture. So look at how corn became so dull and quiet. All the volatility came out of corn as it came closer and closer to its liftoff. And this is a very dull, tight, quiet pullback, which is exactly what you'd expect to see in the final phases of accumulation. And here we can see very dull and quiet as it pulls back and tests these prior lows. Well, look at this. These are all higher lows all the way through. People have been very bearish on corn throughout this whole period. And during this, very quietly, corn has just continued to make higher lows throughout and became very dull and quiet into a pivot. Let's show you the pivot. So pivot, pivot, big uptrend, and then boom, it just pivots out of there. And this rally really demonstrates that there's a shortage of supply, very difficult to buy corn at this time. And the question is, will it continue? So let's see if we can look at another chart. Oh, so look at this. This chart is a weekly chart that goes back 10 years. And here is a picture of the complete accumulation area. Now notice this, we are up against the prior highs and have actually gone slightly through them. So this is a very compelling picture because of the extreme move here, persistent extreme move, pivot, and resistance. Didn't do that very well. But now this whole area becomes potential accumulation. So now what we would want to see is we'd want to see a pause that doesn't have a lot of volatility, dull and quiet, which shows that supply is not coming back in and pushing prices down as it did here and here and here. So this would really be very compelling. Now, to conclude, the point and the reason we look at these soft commodities is because these are the instruments that need to precede inflation. It always shows up in the raw materials, goes into the finished goods, and then results in higher prices. And so we are starting to see activity in these raw materials, in foods, in lumber. We haven't seen it yet in energy, but it appears to be there. So with that, thank you so much for being here. Have a great summer. I will see you next week.